I will introduce myself. My name is Ridho Fatahilah Joeda with NPM 2331111 from Class S, I-23B. Here I will explain about the accounting cycle. The accounting cycle is a series of routine accounting activities carried out by companies in an accounting period. The accounting cycle includes recording, classifying, summarizing, reporting, and analyzing the company's financial data. I will explain in more detail about the accounting cycle. First, transaction. Transactions are financial events that must be recorded by the company. Examples of transactions include purchasing goods on credit, selling goods in cash, paying salaries, and so on. Transactions are recorded in proof of transactions such as invoices, receipts, and memos. Second, journal. Recording transactions into a journal based on proof of transactions. In the journal, transactions are debited and credited to specific accounts. For example, a cash purchase transaction will debit the inventory account and credit the cash account. Third, ledger. Journaling to the ledger. Transactions that have been recorded in the journal are posted to ledger accounts based on the type of account. For example, cash purchase transactions are posted to the inventory and cash accounts in the ledger. Fourth, trial balance. List of debit and credit balances of all ledger accounts. Used to check the balance of accounts before preparing financial statements. Fifth, adjusting entries. Additional journals at the end of the accounting period to recognize unrecognized income and expenses. Example, accrued salary expense. Sixth, financial statements. Preparation of financial statements such as income statement, statement of changes in capital, balance sheet, and cash flow statement based on adjusted accounting data. Seventh, closing journal, closing entries. Journal at the end of the period to close nominal accounts, income, expenses, to the profit/loss account. Real accounts, assets, liabilities, equity, continue to the next period. And the last, the post-closing balance sheet. The real account balance sheet at the end of the period that will become the opening balance sheet of the next period. The accounting cycle starts again from the beginning. I will continue the explanation of the accounting cycle. So the conclusion about the accounting cycle is: the accounting cycle is a series of routine accounting activities that a company performs in an accounting period. The purpose of the accounting cycle is to record, classify, summarize, and report the company's financial transactions. The stages of the accounting cycle consist of 1. Identification and recording of financial transactions to journals. 2. Posting of journals to the ledger. 3. Preparation of trial balance. 4. Adjustment with adjustment journal. 5. Preparation of financial statements. 6. Closing journal. 7. Balance sheet after closing is the beginning balance of the next period. The accounting cycle repeats periodically, usually quarterly or annually. The main output of the accounting cycle is the financial statements that show the financial position and performance of the company in an accounting period. Thus, the explanation of the accounting cycle and its stages. The accounting cycle is important to accurately record, classify, summarize, and report the company's financial information.